For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
It is Managing Your Financial Future. Welcome back to the program. Podcast time. Johnny Dean, your podcast host. We are here live as we can be, with Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. Longtime listeners know some of the stuff that we talk about on this particular show. Rick, you and I have been longtime listeners since, what we used to call this, you remember when we called it bucket strategy investing?
Oh, yeah?
Yeah, that was on the TV portion. That
was a long time ago.
It was a long time ago, but we kind of limited ourselves, I think, back then to talking more about the bucket strategy, which is fine. But as I'm looking through some of the topics that we've talked about on this show, a lot of it does obviously relate back to the bucket strategy, because for us, that is kind of a driving force in financial planning. I know for you, Rick, that is the driving force pretty much in your daily planning life.
Well, when it comes to investing, it is. How do we know how to invest if we don't have a purpose for the money we're investing? So we have to identify what the purpose is, and the buckets gives us the framework for identifying the purpose, for allowing ourselves to pick and choose what we're supposed to be doing.
Well, that it does. And people know it's a big part of how we think retirement income should be planned. But, every once in a while, and I think maybe once a year or so, I do like to step back and I'd like to look at how other people are describing the bucket strategy or saying how it should work. And, sometimes they get much of it right, but more often than not, they only get maybe part of it right. And then other times, it's not good. So I think what we need to do is occasionally clear the bad apples out of the barrel as much as we can. I think people hear bucket strategy, and if they know anything about it, they picture a few years of cash sitting off to the side, and then a stock bucket for later, and maybe a middle bucket, maybe not. We're going to get into this here in just a second, but that misses a lot of what actually makes the strategy work. Now, Rick, we make a clear distinction, or try to, between a bucket strategy, which is kind of it's like a quasi-time segmented plan, and what we call the bucket strategy, which
I think the appropriate way to do it.
Yeah. Well, when it's done correctly, it affects how you generate cash flow. I think it affects how you survive market downturns and recoveries, which is part of it. How you deal with taxes, how you decide when to refill certain parts of your portfolio, and also, and this is important, how you keep yourself from doing something emotional when the markets turn ugly.
Controlling your emotions, both on the good days and the bad days, because on the good days, the positive emotions, the greed, we want to buy at the top of the market. And then we are complaining when it goes down, and we want to sell when it goes down. And buying high and selling low and trying to manipulate your market in doing that is not a good way to manage your money.
No. So I'm going to clear up a few things today. Now, this past week, as I do, like I said, about once a year, I searched around this thing they call the internet, and I found maybe, a dozen or so different descriptions of buckets. And what I found, as I discovered just about every year that I do this, is that there's far more, misinformation, if you want to call it that, than there is helpful information. These are things that people say about the strategy online, things that people assume, and things that might sound maybe reasonable until you really just look at them, not even with a microscope. You just study them for more than a minute. So, Rick, I'm gonna throw some of these things out, some of the misconceptions, and let's start with the one that I see all the time. It never ends, and that is the idea that the bucket strategy is just carving off a couple of years of cash and then putting the rest in stocks. Why is that not the same thing that we're always talking about?
Well, I remember a while back now, 10, 15 years ago, we were doing a seminar. We were talking about buckets. And the guy says, one of the gentlemen in the front rows was saying, well, if I need $50,000 a year and I keep $100,000 in cash, isn't that a buckets plan? I said, that's part of a buckets plan, but 2 years worth of cash. If we look at the downturns that we've faced over the past 100 years or 80 years. Well, basically since the 29 crash. The average downturn lasts, 18 months or more. That's the downturn. That's the time to get from the top of the market to the bottom of the market. That's not the time to get from the top of the market to the bottom of the market, back up to the top of the market where it was. That's not recovery time. That's just to get to the bottom. So all that does is kind of ensure that you're going to hold on to your money and sell at the worst possible time. It's like if you're going to go through that, either sell when the market's down 2%. Of course, that does it every day now, every other day now, or have enough money to not just get to the bottom of the market, but get through the bottom of the market and actually recover to where that market investment has a chance of creating a positive return. So, and unfortunately, we're getting a little jaded because the last couple of years we've seen some downturns, 18, 20%, but they only last 6 months to a year. And so people are now getting jaded that, well, the big one can't happen. We have a new world. We've got a new paradigm. Downturns don't take as long. Yeah, just as you get comfortable with that, you're going to find one that does. And so we want to have the ability to withstand the downturn and the recovery. Not just, we don't want to make it to just the bottom. We want to make it to the, I'm climbing down a well, and I have just enough energy to get to the bottom of it. I've got no more energy. How am I going to get out?
Yeah, that's a pretty good analogy there. Now, you mentioned somebody thinking 2 years, 3 years. We know that's not enough. And for most people who listen to the show know we advocate 6, 7 years. I say 7 years, let's just say. Very quickly, Rick, how do you arrive at a 7-year bucket strategy? Where did that come from?
You don't do 7 years in a vacuum. It's not just 7 years, because that's our bucket number one. But we also use bucket number two. And bucket number two is not a pure stock market investment. We're not going straight into the stock market with bucket number two, because bucket number two has to replace bucket number one 7 years from now. Now, if with a 7-year time horizon, I can afford to have some illiquidity, some lack of access to the money. I can afford to have some volatility, but I cannot afford to have the straight pure market volatility with turning into risk in just 7 years, because there have been, although not many, there have been a few 7 plus 8, 9, 10-year periods of time where the market did not produce a positive result.
Well, and this is another thing that people get wrong about buckets. You and I had a discussion not too long ago about bucket two, how it's the most it's probably the most difficult bucket to talk about or to fill, but it is an important bucket. It is the buffer between your non-volatile
bucket
money.
Number two is a necessary bucket, and it's a problem both from an investment standpoint, because there's quite a few different investments that could potentially fit in it, but it's a problem from an emotional standpoint. Because it seems like 7, 8 years is a long enough time horizon where we can go pure stock market, but it's not all the time. And that's what we're working with. There are times where 7 years, 8 years is not enough time for the stock market to produce a positive return. But it's a short enough time frame where we think, I can't take the risk. It's a long enough time horizon where I want that return, but I don't want to take the risk. And so the idea of bucket number one just being 7 years, that's only appropriate if we have bucket number two backing it up. And if we look at the appropriate investments that go in bucket number two, we want to have investments in bucket number two that do better than cash, do better than CDs, do better than fixed type accounts, but don't have the same risk volatility as the market as a whole. And this is where traditionally a balanced portfolio fits in well. And if you had started 2007 with a balanced portfolio, the average balanced portfolio, I think I saw the stat, went down like 25% between 2007 and early 2009. Okay, that sounds horrible. But if you look at where it was in 2014, that's the 7-year time horizon we're talking about, you had a reasonable rate of return. Now, I'm not saying that bucket number two should be just a balanced fund. It should, but this is where a balanced fund could be used. But bucket number one isn't taken in a vacuum by itself saying 6 years is appropriate, 7 years is appropriate. We're looking to get a 15-year, 14-year time horizon for long-term growth. And so we know we want 15 years for long-term growth, but I also don't want to stick money in CDs for 15 years, 14 years. So we've talked about in another podcast where the grandiose buckets, the large generic buckets are bucket 1, 2, and 3. Bucket number 1 is the cash flow we're going to distribute over the next 6-7 years. Bucket 2 is designed to refill bucket number 1 after that 6-7 year first period of time. And then bucket number 3 is not needed for 15 years because bucket number 2 creates 8 more years of distributable cash. But the reality is you're going to bucketize the bucket. Bucket number 1 is not just a money market account for 7 years. Yes, we want to have liquidity. Yes, we want to have stability of principal. Yes, we want to have it available when we want to do it. But we also try to get a good rate of return out of it. And so we want to be able, in many cases, we're laddering bonds. We're laddering fixed annuities after 3, 4, 5 years to be able to get better rates of return. So there's going to be multiple investments in bucket number 1. And the same thing's going to happen with bucket number 2, depending upon the size. If we've got an account like the traditional hypothetical $1 million account where maybe $350,000 ends up at bucket number 2, it doesn't all have to be in a fixed account, or it doesn't all have to be in a balanced account. You can go half and half. So maybe you put 150 of it into a 7-year contract, CD, fixed annuity or something, with a guaranteed rate of return on it, absolute guarantee of principal from the issuing company. And so we're not worried about the principal. We're not worried about the interest. We know what we're getting, and it's better than what we can get on a 1, 2, 3 year CD. But then have the other 200,000 of bucket number 2. Remember I said bucket number 2 in this hypothetical was 350. Put 150 in to the guaranteed one. And that way, if the markets do really, really well, we can always use the balanced portfolio to fill bucket number 1. Or if for some reason the markets haven't done that well, we can buy three more years of bucket number 1 type money to let the bucket number 2. So we're bucketizing the buckets. But in a general sense, the idea isn't that we're trying to build a 6 or 7 year time horizon with bucket number 1. We're trying to build a 14, 15 year time horizon with a bucket number 1, 2 combo. This is a combo plate here. This isn't just a la carte.
Yeah, so that 70, really the important number here was give yourself 15 years. This is for the bucket number 3 to grow. So rather than take 14 to 15 years worth of safe money, as you're saying, we're going to divide it up into a couple of different buckets. And I think because money that you need for year 12, 13, 14 has such radically different characteristics than the money you need for years 1, 2, and 3, that we call that a bucket 2.
And the 15-year time horizon is basically, we're looking at that from near market high time horizons. So if I'm near a market high now, maybe I was at a market high last week and it gave back a little this week, I'm looking to go for a 15-year time horizon from today forward. On the other hand, if I'm now down already, last year, a year and a half ago was the market high, and I'm down 25, 30, 40% from a market high, or I should say the market is down 25, 30% from the market high. I'm 2 or 3 years into this downturn. I don't need 15 years yet. I only need 12 or 13 years. And so
historically speaking,
we're using buckets not as a one-stop shop for the same thing for everybody. Nobody is this. We all have different needs, wants, desires, and emotional aspects towards the game. But where are we at the market? Are we at a high point in the market? Are we at a low point in the market? Now, if you're doing this in 2007, you wanted a 15-year time horizon for buckets 1 and 2. If you're doing this in March of 2009, you didn't need a 15-year, because remember, the 15-year is to help you get over a downturn and the recovery. But if I'm already down 45%, I don't have to go through all the time of the downturn. I'm already there.
And we are not saying, by the way, that we always know where the market high is or not.
We don't know.
No, but there's going to be a high, there's going to be a low, and that's just what happens cyclically.
I mean, I saw a stat, just recently, the Dow has had like 28 or 29 new market highs this year. And so should we have been selling on every one of them if we could predict it? No, because we went to another new high a week later or something. You can't pick the market high because they happen all together and then they go down for a while and then they come back. And it's like, just understand that you want to avoid selling when the markets are low. So you have to have enough cash reserve, buckets 1, potentially bucket 2, backfilling it, to get through the downturn and back to a recovery point before you sell your volatile assets.
Well, so two of the things that we've talked about so far that people get wrong, or it's just take a couple 2-3 years off and then the rest is stock. That's not going to work. And the other one, which is related to that, is that people don't have a bucket too; they forget about it. And then the other one you kind of brought up here just in passing, but it's true when you talk about bucketizing the bucket. A lot of people are under the impression, I think. It's not a dangerous impression, but it's a wrong one. That it's just you put everything in bucket 1, years through 1 through 7, then years 8 through 14, 15, you got bucket 2, and they aren't doing. You're not doing anything to it. It's set it and forget it. You spend bucket 1 all the way down to 0, and then when that's at 0, you take everything in bucket 2, you dump it into bucket 1. And bucket strategies are often described as that. And Rick, while they may be like that, that's not generally the case, right?
Well, there have been some studies, and it depends on what you use in bucket number 2, that if you are using good quality bucket number 1 and you use a guaranteed account, maybe you just want to get 5%, you can probably get a little bit more than that, 5% guaranteed for 7 years, and turn it into a new bucket number 1 for the liquidity after that, that you can just basically kind of set it and forget it. And then after 15 years, the thought process there is that the markets have recovered and done so well that even if all you're doing is taking just the dividend from the market accounts, you don't sell anything, that you won't have to sell very much to maintain the income that you need, and you'll never run out of money that way.
What's your
I'm
thought
not
on
a
that?
huge fan of that, only because maybe I'm more of a control freak, but I don't want to leave anything to the market because it's never been my friend when I need it to be my friend.
Yeah, and what you're talking about in that scenario is you would spend all of bucket 2,
bucket 1, spend all bucket number 2,
and you're left
now
with
all I have left are stocks.
Yeah,
15.
and if that would have ended that cycle in 2009.
Well, but if that meant you started in 1995, which meant you probably did okay.
Possibly, but there's some
or
risk
1994.
there. There's some
risk
there.
There is risk to it, and it's. I think it's less the financial risk as it is the emotional risk, the emotional attitude toward things. So I like to be in control. Me being a control freak, I guess I am. I don't know. I want to make sure that I'm always looking. The reason we do buckets is to prevent a negative happening with a downturn in the market, a severe downturn shortly after we start the plan. But that doesn't mean that's going to happen. It means that we're protecting against the potential that it happens. But what happens if we're experiencing wonderful years over the next 3, 4, 5 years? The buckets strategy protects against negative volatility, but it can also identify positive volatility, which means opportunity to take some cream off the top, opportunity to refill my buckets and reset. Maybe 3 years later, I've only got an 11-year time horizon. I can reset my buckets, reset them to a new 15-year period of time. And how often we do this is not we've tried several times to figure out a way to do rules of do this, do that. And it doesn't work that way because everybody's different. Not everybody works the same way. But it also depends on what you've invested in bucket number 2. Because if I'm investing in bucket number 2 in that fixed guaranteed account that gives me a 5.5% rate of return for 7 years, come heck or high water, it won't be higher, it won't be lower, and it is 100% liquid at the end of 7 years and ready to refill bucket number 1 when bucket number 1 is basically depleted in 7 years. I don't have to worry about opportunity at that point. I know exactly what I've got. I'm not looking to sell early unless interest rates change dramatically on the upside, which I'm hoping not to see. On the other hand, if my bucket number 2 is in a balanced portfolio, remember I talked about those are two kind of the basics for bucket number 2, a long-term fixed account or a balanced account. Well, if I'm in a balanced account and I've had very good growth over the next 3 years, 4 years, I'm probably not going to wait till the end of the 7th year to refill or to reshuffle the deck, so to speak, and reset my time horizon to 15 years. Because while I've had a good 4 years, what I do not want to have happen is give back that wonderful, exceptional growth that I've experienced in the last 2-3 years before I need it. So I'm looking for that opportunity to take advantage of the volatility that is on the positive side, knowing that I've got the time horizon to protect against the volatility on the downside.
Well, and this is why we don't consider it to be a set and forget it. Although you did say, potentially you could do it that way. And, related to that a little bit, kind of what you were talking about here, we carve off out of $1 million portfolio, just to make the math easy. You're generally carving off about 2/3 of that, roughly, depending, out of that's not going to be in the market, and
not 100% in the market.
Right. So I think here's another thing that people, I don't want to say get wrong, because, well, maybe they do get it wrong about buckets, but they believe that buckets underperform total return investing. But I think, number one, even if they do, I think they're missing the point. Because that's another point that they get wrong, which is that they're judging this strategy by return instead of risk management. Discuss, if you would, those 2 points there.
Well, they're judging it based on a buy and hold strategy. They're looking at average returns over X number of years. And that doesn't work when you have a total return portfolio that you're taking a distribution from, because that volatility significantly reduces your overall rate of return. Because even in a good year, there's a down time during that year. We look at 2024, we look at 2025. Those are pretty good years in the market from January to December. But if you remember those years in early the year, even early this year, there were down days. There were down. Mm-hmm. And if you're taking a distribution from that portfolio when it's down, that money can never recover, and that money can never be part of the average again. That long-term buy and hold average. So it's not that the buckets underperforms the total return strategy. It does if you don't take any distributions. But if you don't take any distributions, why'd you set it up that way? Buckets is based on distributions. It is a way to help create a stable distributable event and not worry about the stock market. Whereas a total return portfolio, aka a balanced portfolio for the whole thing, taking a systematic withdrawal, does not work as well, because anytime the markets go down, and it doesn't have to be a 20, 30, 40% decline. You start in the year one and you're down 5 or 6%, which most people don't even bat an eye at anymore, and you're taking distributions. Not only did you not earn anything for those 5 months, but those monies that you were distributing, you had to sell more of the assets than you would have in the first months to get the same dollar amount you had before, and that money can never recover because you spent it. So they're comparing the rate of return that you get on a buy and hold, and they're not introducing the idea that distributions affect that dramatically.
Do you ever, when you're talking with people, do you ever get any pushback, until you explain it like that, but do you ever get pushback from people who say, well, gosh, you're keeping like 2/3 of my money basically out of the markets? Is that a good idea? Do people ever say that, or does that not come up because of the way you just explained it?
Nobody second guesses me. No, I'm kidding.
You are the professor. Darn it.
Do you know who I am? Yeah, whatever.
Right. You could do those old American Express commercials. Do you know who I am?
Well, and to say that you're not in the market, if you're using a balanced portfolio for bucket number 2, then half of that portfolio is stocks, half of it's probably bonds, or very close to that, somewhere in that area. So you're not 1/3 in stocks only, you're probably half in stocks. Mm-hmm. It's just how we use them. And we've identified the ability to use them in a different fashion because of the way they're being managed in that portfolio versus a pure stock portfolio. So I don't get any pushback on that. And most of the people, when we talk about looking at their buckets, and we're, a lot of times we'll get somebody coming in getting ready to retire, and they haven't looked at their portfolio in, ever. And they're saying, can I retire? And they're 95% in stocks, because that's what's worked up until now. So let's get you out of those before the market crashes and you can't retire. And so they start realizing, that was too much. And then when they start getting closer to retirement, they start watching their portfolios more. And when they start watching their portfolio more, they see it go down. If you've got that proverbial $1 million, they see it go down $20,000 in a 2 or 3 day period of time. They're like, ooh. That was 6-8 months of spending, or 5-6 months of spending
that I don't have
anymore.
There, actually.
Yeah. And so they start realizing they need to be a little bit more moderate, conservative. And when we show them how the strategy works, they're like, yeah, that makes a lot of sense, because now we are identifying a purpose for every dollar in the portfolio. The purpose for this dollar is to be spent next year. It has this type of parameters. It should be invested this way. This dollar is for this. This dollar is for that. Let's back up those specific needs with the appropriate investment. And people are like, and so the only thing then becomes, should it be 13, 14 years instead of 15 years? Should it be a 6 and a 6 or a 7 and a 7?
Yeah.
Or then it's just a discussion there. And that has a lot to do with risk tolerance. It has a lot to do with what their spending is about. Is it something that's, I really want to be able to do that? I think I want to be able to do that, but I may not do it. And so do I really need to have that much money? I want to have the money just in case I need it. Or is it, I've got no choice. I need that money. So there's how the income is structured. A lot of it also has to do with the family life, the family history, the parental units above them, if they're still here. And, they're like, well, I could probably get, my parents are 85, 86, 87, and I don't necessarily need a 15-year bucket 1 and 2 combo, because unless my parents live to be over 100, we're going to inherit something. Now, we don't know exactly where we're going to inherit, but they're worth $4 million, and there's only 2 of us kids, and so we're probably going to get something. And we can. So some people will look at their buckets with that kind of I don't necessarily need 15 years, so I can be more aggressive and try to build more money for my kids, because I can't change the way my parents are investing. I can change the way I am.
But the thing that's not driving the discussion is, how can I get the highest rate of return? I mean, rate of return is there, but it's only a byproduct, something that
it is exactly a byproduct. It is, once you've identified the need and the appropriate type of investment you should be using, how do I get the best return within the parameters of that type of investment? And that's why bucket number 2 is so hard, because it's long enough that we think we should get a really good rate of return, but it's short enough that we could screw it up. And so we have to, you can't go pure stock market.
Yeah.
And so, we know that the money we're going to spend next year, we don't want to take any risk with. We know we're going to accept a 3 or 4% rate of return. And the reality is, the 3 or 4% rate of return versus a potential 10 or a potential minus 10. Yeah. And compounding really hasn't had a chance to take effect that much. It's only a couple months difference in return. But over 10, 15, 20, years, those differences come into the difference between a 3, 4% rate of return and a 8, 9, 10% rate of return. And now we can use averages because we're not taking distributions on that. It's a big difference.
It's a huge difference. And, I think a good way to look at it is that people can think that buckets are just a way to divide money up. But really, it's bucket strategy is a way to manage time. It's a way to manage risk. It's a way to manage cash flow. It's a way to manage behavior. Big part of that. Manage taxes. I mean, it's a lot more than just what I think people.
It is a way to divvy up the money with a purpose. It's not just divvying it up for the sake of divvying it up, segmenting it for the sake of segmenting it. It's segmenting it with a purpose for the dollars invested. It's very hard to figure out what the best investment is when you have no need for the money. And unfortunately, for some people, they have rental income, pensions, whatever the case, more money coming in than they'll ever need to spend or can spend. They've been savers all their life. They're not, spenders. They're frugal, and they're saying, yeah, I've got this $2 million portfolio, but we're retired. We've been retired for 10 years, and we're adding to it every month because we just have more money than we know what to do with. Oh, darn, right? Yeah. But that's the hardest portfolio to figure out how to manage, because if they tripled it, it wouldn't affect their life in any way, shape, or form. If they lost it all, it wouldn't affect their life in any way, shape, or form. So there's no purpose for the money. So now it becomes, well, what is this money for? Is it for the grandkids? Is it for the kids? Is it for charitable purposes? Let's find a purpose for the money so we have a reason of why we're investing it.
Well, this is what you get when you talk to an advisor like Rick, who has talked to people and has experienced all these real life situations and knows how to apply them. I mean, is the bucket strategy simple? Well, I guess in a way it can be simple, but, as Rick just said, you're matching dollars to time horizon. You're trying to make sure the dollars you need sooner are handled differently from the dollars that you might not need for many years. So it's not just putting cash in one place and stocks in another. As I said, manage risk, cash flow, taxes. You got to be able to survive market downturns. All of that is very important. And then when when each dollar has a job to do, it's easier to stay calm and let the long-term money do its job. So, and if it seems like we talk about this a lot, it's because we do. But we will keep hammering these points home. You can't control the market. You cannot control when the next downturn happens, but you can control how your retirement income strategy is built, whether the downturn is here or it's just around the corner or it's, 10 years from now. But believe me, downturns, there's another one a-coming. We just don't know when. Right. So you got to be ready. If you'd like to learn more, certainly you can reach out to the advisors like Rick Plum at Lucia Capital Group. Give them a call, 800-644-1150, 800-644-1150. You can visit us online at luciacap.com. We get a lot of folks visiting that site, which is wonderful, luciacap.com. We have so many resources there at Lucia Cap that you won't be able to go through them all. But while you're there, just take a look at the Bucket Strategy Guide. If you haven't done that, type in Bucket Strategy in the search bar at the top, and you can download it and just read it. We read as much or as little as you want. But if you need help understanding some of this stuff, and maybe if you're a new listener or whatever, just search Bucket Strategy, and you'll be able to read about it. We've also got guides on Social Security. Estate planning, rollovers, retirement income, all that stuff. So check those out. They're all free for you to download. Don't forget to subscribe to Managing Your Financial Future. That's this podcast on Apple Podcasts or Spotify. You don't want to miss any future episodes. We are out of time. My thanks to Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. I am your podcast host, Johnny Dean. Thanks so much for listening to Managing Your Financial Future. We will talk with you all again next week. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The information provided is not intended as tax or legal advice. Always consult a tax or legal professional for specific advice regarding your individual situation. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and or transaction costs and does not assure a profit or protect against a loss. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Stock investing includes risks including fluctuating prices and loss of principal. The Dow Jones Industrial Average is comprised of 30 stocks that are major factors in their industries and widely held by individuals and institutional investors. Indexes are unmanaged and cannot be invested in directly. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Money market mutual funds, though traditionally lacking federal insurance, are not without risk and are highly regulated under federal law. Before investing, carefully consider a money markets or a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Fixed annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxable as ordinary income upon withdrawal. Guarantees are based on the claims-paying ability of the issuing company. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. LPL Financial Insurance License number 05-18721. LPLIA Insurance License number OB 91442.